What if I told you that even professional investors struggle to buy at the perfect time? Market timing sounds ideal, but it rarely works. The idea of swooping in when prices drop and selling at the peak is tempting, but the reality is much more complicated. Even experts with years of experience and advanced tools often miss the mark, and waiting for the perfect dip can lead to missed opportunities as the market keeps moving up. Today, we'll break down why trying to buy the dip can be one of the biggest traps for investors and how a simpler, steady approach could actually deliver better results. By the end, you'll know exactly why consistent investing often outperforms chasing dips and how this strategy can save you stress and help you build wealth over time. Stay tuned as we uncover what really makes investing work and why so many people find market timing nearly impossible. Most people imagine that with enough experience or the right tools, you could figure out exactly when to jump in and out of the market for maximum profit. But the truth is, even seasoned professionals rarely get these calls right. The fantasy of buying low and selling high is enticing, but reality is far more unpredictable. Markets move for countless reasons: economic reports, global events, investor sentiment, and these factors collide in ways no one can reliably forecast. Predicting market moves is like guessing the exact moment it'll rain. You see clouds, but you can't pick the precise drop. The stock market doesn't follow a set schedule or pattern. One day, a promising jobs report sends stocks up. The next, a sudden global event drags them down. Trying to anticipate these twists and turns is less science and more guesswork, even with all the charts and data in the world. To see just how tough market timing is, let's look at a study by Charles Schwab. They created a fictional investor, Peter Perfect, who had the superhuman ability to invest at the absolute lowest point of the market every single year for 20 years. Over that period, Peter Perfect ended up with about $138,000. An impressive sum. But here's the thing: no one can actually do this in real life. Even the best money managers, who spend every day analyzing trends, rarely hit the bottom at just the right time. The Schwab study makes it clear that perfect timing is more of a fantasy than a strategy. Trying to time the market is often compared to catching a falling knife. If you go for it and miss, you risk getting hurt. If you buy during a downturn thinking it's the bottom, prices can keep falling. If you wait too long, the market might rebound and leave you behind. It's a guessing game without clear rules, and most people end up missing out. Another problem with waiting for the perfect moment is that the stock market's biggest gains often come suddenly and without warning. Imagine you're holding onto your cash, waiting for a dip. Then, out of nowhere, good news hits. A breakthrough invention, a strong earnings report, or a surprising government decision, and the market surges. If you weren't already invested, you just missed a major upswing. Research shows that missing just a handful of these big days can seriously hurt your long-term returns. Over time, markets tend to go up, and sitting on the sidelines waiting for the stars to align can mean missing the ride entirely. Let's return to that Schwab study for another perspective. Alongside Peter Perfect, there was Ashley Action, who simply invested her money as soon as she got it, and Larry Linger, who waited for what he hoped would be better opportunities. While Peter's perfect timing earned the most, Ashley's consistent approach came surprisingly close. She didn't worry about hitting the lows, she just stayed in the game. Larry, on the other hand, kept waiting for the perfect dip and ended up with much less. The big takeaway? You don't need perfect timing to build wealth. Staying invested and not overthinking every market move puts you ahead of most people who try to outsmart the system. It's also important to consider the emotional side of market timing. When markets drop, panic often replaces logic. Investors who are waiting for the right moment might freeze up, second-guess themselves, or pull out at the worst possible time. These reactions can lead to missed opportunities or losses, making the whole process even harder. So, if even the experts can't reliably predict market highs and lows, what's a better way to approach investing? Instead of trying to guess the perfect moment, there's a strategy that lets you put your money to work without all the second guessing. It's an approach that doesn't rely on timing at all, and it could make investing a lot less stressful. One of the simplest yet most powerful investing strategies is dollar cost averaging, or DCA. This approach means you invest a fixed amount of money at regular intervals, say every month, no matter what's happening in the market. Whether stocks are rising, falling, or moving sideways, you stick to your schedule. There's no need to guess where prices are headed or stress over whether now is the right time. You just keep investing, building your portfolio step by step. Let's look at why this works. The main strength of DCA is its ability to take emotion out of the equation. Imagine the anxiety that comes with trying to pick the perfect moment to invest. Markets dip and you hesitate. Maybe they'll drop even more. Or they rebound suddenly and you're left wishing you had acted sooner. This cycle of hesitation and regret is what trips up so many investors. DCA sidesteps all of that. By making investing automatic, you avoid the temptation to overthink, and you don't get swept up in the latest headlines or panic during downturns. Think about two investors, Alex and Jordan. Alex uses DCA, putting $500 into an index fund at the start of every month, regardless of market news. Jordan, on the other hand, tries to wait for the best opportunity. He only invests when he feels stocks are on sale. Over time, Alex's approach might seem uneventful, but here's what actually happens. When prices are high, her $500 buys fewer shares, and when prices are low, it buys more. This averaging effect means her overall cost per share smooths out, capturing both the dips and the recoveries. Jordan, meanwhile, faces a different challenge. He has to decide what a true dip looks like and when to act. Sometimes he waits too long and misses the rebound, or he jumps in too early and sees prices fall further. In the end, Jordan's returns often lag behind Alex's steady, disciplined results. This isn't just theory. It's backed by real-world data. The Charles Schwab study tracked several hypothetical investors over 20 years. Matthew Monthly, who used DCA by dividing $2,000 into equal monthly contributions each year, ended up with over $124,000 by simply sticking to his routine. That's remarkably close to Ashley Action, who invested all her money at the start of each year and finished with just over $127,000. The key takeaway? Consistency and discipline come surprisingly close to the results of perfect timing without the stress or need to predict the future. DCA also fits naturally into everyday life. Most people earn a steady paycheck, so setting aside a portion for regular investing is straightforward. You can automate contributions to your retirement account or a favorite index fund, making investing as routine as paying a bill. This method not only builds wealth gradually, but also helps you avoid the risk of making one big investment at the wrong time. The psychological benefits are just as important as the financial ones. When markets drop, it's easy to panic and sell or to freeze and do nothing. When markets surge, you might hesitate, worried you'll buy at the top. DCA removes that pressure. You're not trying to outsmart the market, you're simply following a plan. This frees up mental energy and keeps you focused on your long-term goals rather than getting distracted by short-term noise. And beyond numbers, DCA removes a huge mental burden. Let's explore that next. The reality is, while DCA helps you avoid a lot of the stress and indecision of market timing, the idea of buying the dip still has strong appeal. After all, who wouldn't want to scoop up stocks when they're on sale? But before you decide to wait for the next downturn, it's important to understand what makes this strategy so tempting and why it doesn't always work out as planned. For many investors, the idea of buying the dip is hard to resist. The concept is simple. Wait for prices to drop, swoop in at a discount, and ride the recovery back up. It's the classic buy low, sell high dream, and on the surface, it seems like a smart way to get ahead. But beneath that appeal lie some very real challenges, and the numbers show just how tough this strategy can be. Take the case of Larry Linger from the Charles Schwab study. Larry waited for what he thought were the right moments to invest, holding back his money until he saw a dip. After 20 years, his portfolio grew to only $44,130, far less than those who invested consistently. This result isn't just an outlier, it's a clear warning about the risks of waiting for the perfect entry point. Even with patience and good intentions, the market doesn't always cooperate. A big part of the problem is defining what actually counts as a dip. Is it a drop of 5%, 10%, or something else? Even experts can't settle on a clear percentage threshold, which leaves most investors second-guessing themselves. If you buy after a 10% decline, there's no guarantee it's the bottom. Prices could easily slide further. That uncertainty means you might end up buying too soon, watching your investment lose value as the market continues to fall. On the other hand, if you hold out for a bigger drop, you risk missing the rebound altogether. The Schwab study found that waiting for the perfect moment often means missing out on the market's eventual recovery, leaving your cash on the sidelines while others benefit from the upswing. This ambiguity can quickly turn into frustration. If you're always waiting for a better deal, your money might sit idle for months or even years. Meanwhile, the market moves on, and the gains you hoped to capture slip away. There's also the risk of acting too early. If you spend your cash on an initial dip and the market keeps dropping, you're left with fewer resources to take advantage of deeper discounts. It's a tough balance, and most investors don't get it right. The emotional side of buying the dip makes things even trickier. When markets fall, it's natural to feel anxious or fearful. A small dip can seem like an opportunity, but as prices keep falling, worry sets in. Questions like, is this really the bottom, or what if things get worse, start to cloud your judgment. Instead of making a confident move, you might hesitate, delay, or even panic sell, exactly the opposite of what you intended. The Schwab study highlights how, when markets drop, panic often overtakes logic, leading to poor decisions and missed opportunities. It's important to realize that even professional investors struggle with these same challenges. The Schwab study's results make it clear. Perfect timing is nearly impossible, and those who try to wait for just the right moment often come away with the lowest returns. While Peter Perfect, the hypothetical investor with flawless timing, ended up with the most money, this scenario is unrealistic for almost everyone. In real life, the disciplined approach of steady investing produces results that are competitive and much less stressful. That's not to say buying the dip can never work. If you have a plan, clear limits on how much to invest during downturns, and the discipline to avoid emotional decisions, you might pick up extra value during rare, sharp corrections. But as the Schwab study showed, investors like Ashley Action, who simply invested consistently, outperformed those who waited for dips. Her returns were steady, and she avoided the emotional roller coaster that comes with trying to time every move. The takeaway is that buying the dip works best as a supplement, not a main strategy. If you rely on it exclusively, you're gambling on your ability to predict the unpredictable. But if you combine steady, disciplined investing with the occasional opportunity to buy during significant downturns, you can capture both stability and potential for extra gains. So what does that balance look like in practice? Many long-term investors find ways to stick to a routine while keeping some flexibility for rare opportunities. Let's look at how you can blend consistency with the ability to act when the time is right. Combining consistency with opportunity gives you the advantages of both discipline and flexibility. You don't have to choose between sticking to a plan and taking action when the market drops. In fact, many long-term investors use a hybrid approach. They keep their regular investments going through dollar cost averaging, DCA, while also setting aside a small cash reserve to use during significant market downturns. This method strengthens your investment routine and gives you a way to act when prices are especially attractive. It's a misconception that you have to pick a side, either commit entirely to DCA or focus only on buying dips. Both strategies can work together. A disciplined DCA plan keeps you building your portfolio and avoids the stress of trying to time every move. But adding a cash reserve gives you the option to buy more when the market takes a noticeable dip. Used correctly, the two complement each other. You're not abandoning consistency, you're just adding a tool that can help you take advantage of rare opportunities. Let's use a hypothetical example to show how this works in practice. Imagine an investor named Sarah. She invests $300 every month into her portfolio using DCA no matter what the market is doing. Alongside this, she sets aside an extra $50 each month into a separate cash reserve, specifically for large market drops. If the market falls by 15% or more, Sarah uses her reserve to purchase additional shares at lower prices. She doesn't have to scramble to make a decision. Her plan is already set. This approach lets her stay consistent with her core investments while being prepared to act when a real opportunity comes along. The real strength of this hybrid strategy is in the planning. Without a clear set of rules, it's easy to let emotions take over during market volatility. You might hesitate, afraid the market will drop further, or you might rush in too soon and regret your timing. By deciding ahead of time, such as only using your reserve if the market drops by a specific percentage, you set boundaries that help you act confidently and avoid second guessing. The Schwab study notes that many investors keep a little cash on hand to take advantage of downturns, but the key is to avoid waiting endlessly for the perfect moment. Having a plan means you're ready to act, but you're not stuck on the sidelines hoping for the stars to align. This combined approach also helps you sidestep the stress of trying to predict the market. DCA works because it removes the need for constant decision-making and lets you benefit from long-term growth regardless of short-term ups and downs. When you add a cash reserve for market dips, you're not trying to outsmart the market every day. You're simply prepared for those rare, bigger corrections that can make a difference over time. The research shows that this method can enhance returns without increasing anxiety or leading to emotional mistakes. Think of DCA as your regular step. Dip reserves let you leap ahead when conditions are right. The steady pace of consistent investing keeps you moving forward, while the cash reserve gives you a way to accelerate your progress when the market presents a real opportunity. This balance means you're not relying on luck or perfect timing. Instead, you're focusing on long-term growth while still being ready to act when it counts. It's important to remember that discipline is the foundation of this approach. DCA should remain your main strategy, with dip buying as a supplement, not a replacement. Without discipline and a clear plan, it's easy to fall into the trap of waiting too long, acting impulsively, or missing out on gains altogether. The research emphasizes that pre-planning is essential. Deciding in advance how much to invest during dips and under what conditions ensures you stay in control, even when markets get turbulent. This hybrid method isn't about predicting the next downturn or trying to catch every single dip. It's about building a routine that keeps you invested and removes the pressure to be perfect, while still giving you the flexibility to act when the odds are in your favor. Sticking to your plan and letting it guide your actions can make investing less stressful and more effective over the long run. As you consider your own strategy, keep in mind that how you approach investing matters just as much as the tactics you use. Consistency and a clear plan can make all the difference, not just in your results, but in your confidence and peace of mind. When it comes to investing, the approach you choose matters, but the mindset you bring to it is just as important. Warren Buffett famously said that for the vast majority of people, the smartest thing to do is consistently invest in a low-cost index fund. It's not about hitting the perfect moment. It's about showing up regularly and letting time do the heavy lifting. A hybrid strategy, combining steady investing with a plan for rare opportunities, can give you both stability and flexibility along the way. Start small, keep at it, and let your process work for you. Tell me below, are you Team DCA, Team DIP, or a mix of both? I'd love to hear how you approach your own investing journey.